All right, I think the webinar is just being told we're kicking off. So as you can see, David has done very well. He's wearing a jacket and shirt while I'm just in the banjo shirt. So for those of you who don't know me, I'm Guy Callahan, I'm the CEO of Banjo. We'll just give this one more minute for a few more people to log in, and then we'll kick this off. But thanks for joining in. So just patience for one more minute, and then we'll kick things off. Okay, look, in the interest of time, I'm going to kick this off. So first of all, thank you to everybody to attending. What we're going to do, so again, I'm Guy Callahan. I'm the CEO of Banjo Loans. We're really excited today to have David Robertson back again for the second in our webinar series of an economic update. I think it's very, very timely. Very timely to have this update. It was 3 months ago when we did our first one. We're right in the heart of COVID lockdowns 1.0, and now as we go again, well, Victoria does, and COVID lockdowns 2.0, we can really sort of see what's happening as an update out there. We were saying that it was a two-speed economy, that's with some businesses and some industries doing very well and others just really struggling. Now it seems we've got that, and we've also got a two-speed geography thing happening with as different places in Australia's the same, the US, you can look at the same, where different geographies are coming out of COVID and some are still deep down and getting really caught up into it. So before we kick into David, Banjo is really proud to present this in conjunction with Bendigo and Adelaide Bank, our funding partner. I know we'll find this really informative and really good. Banjo, we offer working capital, short-term, unsecured business loans to SMEs in the Australian market. And we work really hard, particularly during this time, but always working really hard to support and drive the Australian SMEs by providing them with short-term funding requirements that will help them write the next chapter of their growth. We've actually got some products that are really perfect for this environment. We have our flexi working capital solutions, which offer we've got two. We're excited to launch our second one. We originally had a 16-month term loan, which had 4 months interest expense only. And in the coming weeks, we'll introduce our 12-month term loan, which will have a 3 month of interest expense only. Bit of housekeeping, everybody's on mute at the moment. If you have got questions, we want to make this interactive as possible. So if you've got questions, please type them to me in the session, and I will attempt to sort of combine as many as I can and ask David some questions as we go through it. We'll have a break around halfway, so I'll ask questions there, and then we'll finish off with some question and answers at the end. But look, I'm sure I'm not the person you've come here to listen to, so let's introduce and get David as the presenter, and he can give us an update. Over to you, David.
Well, thanks very much, Guy, and thank you for the invitation to join you again. I think we're 4 months on or thereabouts from the last update, and a little bit has happened since then. So great to have the opportunity to catch up again. Thanks for the invitation to talk about the economic outlook and the outlook for not just the economy, but for the markets and for society really going into 2021. It's a real pleasure to join you. So good morning. Of course, I'm joining you from lockdown Melbourne, and I'm really looking forward to being able to travel more than 5 kilometres from my home. But it is a bit surreal being back into lockdown. But at least we have technology like WebEx and Zoom and webinars and so on to be able to cope with these conditions. I think I saw recently that the share price of Zoom has recently exceeded the 7 largest airlines in the world. So that's a sign of the time, isn't it? So I'll just show my screen, assuming I can navigate correctly here. Just bear with me for one moment. I assume we're looking at the correct screen here, the one on the right.
We're looking at the moment at your, I think your home screen, David. So you'll just need to bring on to the PowerPoint that we did yesterday.
Yeah, so screen number 2, there we go. How are we looking now?
No, there we go. Yep, there we go.
Very good. So again, thank you for the opportunity to share this information. And look, I do want to talk about the path out of recession and you know, probably the W shape that we're now facing, given the Melbourne lockdowns. And I think when we last spoke, we were talking about a V-shaped recovery or a U, depending on a few different variables. Perhaps before I start talking about the recovery, if I can just mention up front, you know, the devastating impact of this health crisis on aged care, on healthcare workers, and more broadly on society. And I know most of that's in Victoria now, but that impact on aged care in particular is confronting. So hopefully those issues get resolved with urgency. But as we all know now, you know, and as we feared 4 months ago, we're in the deepest global recession for about 80 years and the deepest contraction for Australia in living memory. So whilst we do need to acknowledge that fact and that reality, still, I think there are some positives that remain in place that shouldn't be overlooked. And some of those positives are around relativities with other economies, also our geopolitical position, our geographic relationship, I suppose, with Asia, with our largest trading partners, and the strong position of our economy going into this pandemic. So I think we do need to keep that context. So, you know, for context, we've had the worst of the recession. I think the low point in the recession was in May. Now it's the long, slow path out of recession. So that's what I'd like to talk about this morning. So a few themes to explore ahead of Q&A. And as you said, Guy, we'll perhaps pause halfway through for initial questions. But, you know, I'd like to start globally, then come back to the national outlook, and then look perhaps state by state. But globally, we are going to see divergence between those countries that have managed the health crisis effectively and those that haven't. And in particular, we're starting to see that with Asia and the rest of the world. And given Australia's, you know, 80% of our exports go to Asia, that actually does augur quite well. Secondly, speaking of divergences, or divergences, you know, with the Australian economy, the tragic second wave in Victoria, it's a real setback for the national recovery, but it also does risk a two-speed recovery. And I think that's going to make some of the economic data that we're going to be seeing over the next few months and into next year a bit more difficult to interpret. It'll require a bit more, you know, digging deeper, and potentially, if I'm right about the two-speed economy being in place for some time, it might make us a little more pessimistic about the rest of Australia, as opposed to the outlook for Victoria in the as we see that data coming through. Thirdly, I would like to talk about the cost of the pandemic, and you know, there's a lot of talk about how every week we have an extra, you know, week of stage 4 restrictions, say in Melbourne, how many $1 billion that's costing the economy. I think there isn't necessarily enough discussion, though, or emphasis about where that cost is lying. And the reality is a lot of the cost is lying with government debt. and also with indirectly via quantitative easing. So I think we do need to consider the profile of debt, and also note that Australia can afford it as a AAA rated country. So a few comments around debt and quantitative easing, and I might even get on to MMT, modern monetary theory, time permitting. But there's some themes to explore, and just to get started, I think, obviously the unique aspect of what's happening with the economy all stems from the pandemic, and as it happens, this one is just such an infectious one, isn't it? Much more so than SARS and other examples of coronaviruses over the decades, probably really only comparable with 1918 and the Spanish flu. But I think as this chart shows, you see just how it's hit different regions with vastly different outcomes, and clearly Europe, North America, and now increasingly South America as well, have been most impacted. And then you look at the percentage of mortality that's lying in Asia, and it's probably around about 15%, but of course that's where 60% of the world's population is. So countries that were decisive and most effective with policy, health policy, fiscal support and so on, have been less impacted than those that were slow to react, and also where I think people really weren't on board with the policy decisions. So here in Australia, I'm full of praise for our policy response. Of course, the second wave with stage 4 restrictions here in Victoria does put a lot of that at risk, and that's despite our per capita numbers being very low. But again, beyond the human tragedy, including the impact on aged care that I mentioned before, just getting the health crisis under control is the key to the economic recovery and limiting the financial damage. So, I think a chart that shows that link between the health crisis and the economy is this one on the top right here from the OECD. And this was from about 6 to 7 weeks ago, where they were forecasting a V-shaped recovery for Australia in the instance of a single hit, but a W shape in the event of a second outbreak. And that's unfortunately how things have unfolded, although the fact that this second outbreak is confined to one state and primarily to one city does mean that might have a slightly different shape. But that's really where we are today, and I think that principle also applies to other countries around the world. So let's just kick things off with the rest of the world and key economies. China is an obvious place to start, being our largest trade partner, and very much a case of first in, first out. You'd have to say that Chinese authorities have handled the crisis decisively, and their policy response has been very strong. And you can see, well, there's a V shape in any language. GDP actually higher today in China than it was pre-COVID. And whilst it has been a bit slower for services and retail than industry and construction, that is actually a really strong recovery for the Chinese economy, for the Chinese people, and indirectly for us, being our largest trading partner. I know there is quite a lot of cynicism about some of this data and the official numbers that we get out of China, but actually, if you look at the PMI surveys, the official data was even more alarming than the independent PMIs. So I personally don't have any, I don't question the Chinese recovery. I think it's fairly straightforward. They had a 9.5% fall for the first quarter and then 11.5% recovery in the second quarter. And that's all been helped by the fiscal packages, which has a heap of infrastructure investment behind it. And I know our trading relationship with China is obviously very tense at present, and we saw further examples of that, last week with accusation of anti-dumping around wine and so on. But as it happens, the amount of trade that Australia's undertaking with China continues to hit record highs. And a lot of that admittedly is driven by iron ore, where the price is well above $100 a tonne. But that's very helpful to offset the slump that we're seeing in service exports like tourism and education. So You know, I've sort of tried to put on the table the bad news up front that it is a 1 in 100-year recession, but nevertheless, I think there are some silver linings and some good news items that need to be called out. And good news item number one, I think I've only got 5 altogether, but good news item number one is China's recovery, which appears to be both well entrenched and also has some momentum going into year end. Contrast, however, that recovery for China with the USA, obviously the US being the world's largest economy. And I think the best way to compare different economies and how they've been hit by the pandemic is to look at just total number of jobs. And so this chart shows the US there with 136 million Americans with a job at the start of the century, rising to about 146 million before the GFC, then a decade of growth through to the start of 2020, when you had 159 million Americans with a job. And then remarkably, within 2 to 3 months, all those 20 years of job creation gone. Fortunately, we've seen a bit of a bounce since, but it's just remarkable that the US could go from a 3.5% unemployment rate to 15% in just a couple of months. It's now back to around 10 or 11%. So, you know, I think that chart does tell the story, and the severity of it obviously rests with how they've managed COVID-19. I've just overlaid on that chart, though, the experience for Australia. And for us on the right-hand scale there, it's also been a significant blow, but nowhere near to the same extent as most countries overseas. And so I think those relativities are worthwhile calling out. Another way of measuring that, rather than just looking at total number of people with a job, is total hours worked. And for Australia, we saw a 10% fall in total hours worked. It's now about 6% below pre-COVID levels. Again, compare that to the US, where it fell 19%, Canada it fell 28%, and UK a sizable impact there as well. So, you know, I think those relativities are important, and to reiterate my point that Asia and Oceania have coped a lot better than Europe and the Americas. I've resisted the temptation to put too many Trump quotes in this presentation, because it is a tragedy what we're seeing unfolding in the US. But if you haven't seen the interview between Jonathan Swan and Donald Trump, it is worth a look. Nevertheless, Trump's trying to get re-elected, and he's currently trailing Biden around about 43% to 57%, looking at the polls. So it'd be interesting to see how that goes over the next few months. Let's just concentrate on Australia for a couple of minutes now, before perhaps I pause for some questions. And again, I think it's really all about jobs, and the purple line there is it does show 13 million Australians with a job going into COVID-19, falling to 12.1 million, so a savage hit, and now that's back to about 12.46 million. So, you know, it was about a 7% hit to employment, about a 10% hit to jobs, to total hours worked, as I mentioned before. But there are a few points I'd like to make around the jobs market. Firstly, that the low point for this was actually in late April, early May. And so the unemployment rate that the press obviously focus on has really been lagging the recovery that we've seen since May. The other 2 points to make: firstly, so much divergence between industries, massive variations by region and by sector. Hospitality, arts and rec all hit a lot harder, with the obvious reliance on tourism and mobility. And then more recently, we're starting to see not just the divergence by industry, but also by location. And so you can see how, again, the low point for the jobs market, April, May, a pretty decent recovery for the rest of Australia, but very much back on decline for Victoria. So look, I'll finish off with some firm predictions about some of these numbers. But I do think the two best indicators to track where our economy is likely to head going into 2021 is firstly the new COVID numbers, the new COVID infection numbers, which fortunately have been falling in Victoria, and we're seeing very little outside of Victoria. And secondly, just that total employment number, which, as I said before, has increased from 12.1 million to 12.46 million since May. The divergence between Victoria and the rest of Australia is just going to make it a bit harder to track some of that. So one of the reasons the impact has been less so here in Australia than overseas has been all the fiscal support packages, as well as the 5 RBA rate cuts that we've had, 2 in March and 3 mainly in the second half of last year. So when I say that spending has been supported by those packages and has been picking up, actually retail sales is 12% higher today than it was a year ago, which is a remarkable statistic, I think, and helped by JobKeeper and JobSeeker and other support measures. But there's a large rise in the amount of spending associated with food, but even the non-food component has really kicked up. And then you look at other measures like restaurant bookings and so on, and they're actually a lot higher today outside of Victoria than they were a year ago. So if I can just dive a little bit more deeply into the retail sales numbers. Yes, we're all spending a lot more on food rather than cafes and takeaway and so on. It's probably a good thing depending on the industry you're in. We're spending more today than we were a year ago on household goods, but less so on clothing and footwear. So certainly some behavioural traits that are quickly evolving, and overall we're spending more than we were a year ago, other than in department stores, and so there's been a change in preferences around how we shop. So a lot of that relates to mobility, and I saw this chart recently from the Reserve Bank, which I think shows it very clearly that by whatever measure of mobility, it's still very slow for Melbourne, for other capital cities, getting back to normal. And, I think once they're back to sort of 100%, then that will be when the economy is able to operate at full strength. So, look, it's all been a very stressful period, hasn't it, for businesses, for individuals and for families, but it's all about reopening the economy and reopening the borders. So maybe we will have a food-inspired recovery. Look, I might just pause there for a moment, Guy, being just over halfway through the slides, if there are any initial questions, or let me know if I should just press on.
Yeah, I've got a couple of questions that are floating around, David. But yeah, thanks. It's really interesting. Just for my mind, we were talking 3 months ago whether it's going to be a V shape or W shape or what it was going to look like. I mean, now we kind of know it might be another V on top of the W, depending if there's another spike. So it's interesting. And clothing and footwear sales, surely Ag Week sales has gone up, I would imagine, during this time.
I won't show you what shoe I'm wearing right now, but go on.
I think we might be all on that boat. Okay, so there's been a lot of policies thrown in there, and I think the government's done a great job, like you think there, and a lot of money sort of thrown out there. Is there any things that you think have really hit the mark, and those that have maybe missed the mark with the policies?
Look, I think JobKeeper and JobSeeker have been absolutely necessary, and my only query there is how quickly they're going to be tapered off. I think the JobKeeper 1,500 a fortnight is going down to 1,200 for sort of full-timers, and I think 900 or thereabouts for part-timers, depending on how many hours you're working. So I think that's been really effective, but absolutely necessary. And my only comment around ineffectiveness would be if they taper it off too quickly. So, I think, and I'll come back to some charts around affordability of this via debt, but the main thing is going to be continuing that support until the economy doesn't need it anymore. And I have faith that or confidence that the government will continue that. They don't want to overpromise because they want the economy to be building on itself rather than relying on support. But I've got confidence that they'll continue that support. Maybe what could they be doing further? I certainly think that we can be continuing to do more around infrastructure investment. And there's been a bit more talk about that, and some of that needs to come from state government rather than federal. Also good to hear, suggestions around addressing skills gaps, and so, investment in education. Then you sort of get to longer term structural reforms. But yeah, I think the range of fiscal packages thus far have been effective. Maybe it needs to be a bit more targeted moving forward, and less scattergun, and that seems to be the language we're hearing from the government.
Yeah, okay, thanks, Toby. With a bit of a segue there, and you might be covering this off a little bit later. So yeah, there is going to be a mounting debt. So how's the RBA monitoring that debt? And do you think they'll have like trigger points of pulling back or going harder?
Yeah, and I do have a chart on that shortly, so I'll perhaps just give a brief answer that in terms of trigger points, I think they're still going to be quite comfortable even if gross debt to GDP hits 50%. It's gone from around about 30% pre-COVID to 35%, and the latest forecast is that gross debt to GDP is going to hit 45% by next year. But for the very reasons we've just outlined around needing to do more to support the economy, I wouldn't be surprised if it hits 50%, which is $1 trillion in debt. It sounds like a lot, but when you're a $2 trillion economy, it's only 50% of annual GDP. And so I think that's the sort of line in the sand that the government might be looking at, probably more so the government than the Reserve Bank, who are really just issuing bonds that support that, or through the AOFM, they're issuing the bonds that support that debt. And then there's the quantitative easing side. How much of that debt are the RBA purchasing themselves as opposed to just other investors? But, overall, to be candid, I think it's the least of our problems is our debt levels, because we're a AAA rated country, because the government can raise these funds for 10 years at under 1%. It's a great time to do it.
Yeah, sure. And it'll only aid the recovery, right? So yeah, it's a good thing.
Exactly. And you borrow for 10 years at 0.9%. I'd be amazed if our GDP for the next decade doesn't average more than 2%. So you're well ahead on the deal. Yeah, right. A question that came back around when we were talking about the international side of things, particularly around the USA, there was a significant drop in their employment hours. But they haven't locked down as hard on the restrictions and that side of things. So how does that work? Is that just that people are just not shopping as much, the business is closing down, or how does that actually play out? Well, so they were a bit slower to the party with shutting down their economy and the sort of dramatic restrictions that we've imposed. But they still had them, and so they still you still had the same effect that we've had here in Australia. It was a little bit deferred, and therefore they've been struggling to get the health crisis under control. And you could certainly argue there's a trade-off between keeping the economy going and the health crisis. You're going to have higher infection rates, you're going to have a higher mortality rate. But the US fiscal support for workers that have been temporarily or furloughed, if you like. The trouble is that they've really been scrambling to get the next phase of their fiscal support through. So I think that creates uncertainty, and that uncertainty's been played out through the consumer confidence numbers and the jobs numbers overall. So it's not so much that they didn't shut down the economy, it's just they were a bit slower to do it. And now I think there's a bit less certainty about how they're going to finance the reopening of it. And I do think that's going to have longer term implications. But as it happens, the last few weeks, economic data from the US has been a bit stronger, including in houses. So, they've gone about it in a slightly different manner. and that's very evident in the health data, isn't it?
Yeah, isn't it? Be interesting just to see how long that tail sort of drags on for. I think. Yeah.
Well, exactly,
Okay.
and so I mentioned our debt levels. You know, US debt to GDP is about 110%. So there's some of the relativities.
Yeah, it's a different story. All right, look, that's just a reminder to everybody who's on the webinar today. Please feel free to send questions through to me. They're great to receive, and I'll keep trying to sort of combine them where I can and send them back to David when they're in. But maybe we'll kick on to the next one, Dave.
No worries. Okay, so I'll move on to the housing market and the financial markets and some conclusions. I was just talking about consumer sentiment, and you can see consumer sentiment plunged much deeper than during the GFC, tried to recover, and now that's looking a bit like a W shape there. Similarly for business confidence, business conditions, massive fall. That's actually reclaimed a bit more of the losses than we saw through some of the consumer numbers, but once again, very much dependent on the industry you're in and also where you're located. So just on the business segment, here's a chart, and I think I may have shown just the blue part of this chart last time we presented, but now it's been updated with the data through to July. And so the gold dots show the first month's impact on payrolls. And again, no surprise that hospitality, arts and rec, and some of these other industries have been hardest hit. I'm a bit surprised to see agriculture there, but that's probably got some seasonality to it. But then for most of these segments, things have improved from where we were in mid-April. And so a smaller percentage of job losses in those segments. So for all industries, yeah, that's gone from about a 7 to 8% fall to now around about a 5.5 to 6% fall in total jobs. And you've got some of the essential services here which continue to be required and therefore haven't seen the job losses. As for looking forward though, and we do get some capital expenditure data out tomorrow actually on Thursday, and I think what we're going to continue to see is that mining investment will be rising because of the strength in things like the gold price and iron ore and so on, whereas non-mining is really where we're taking the hit, and that's the broader business environment. And for business investment, businesses naturally have put off spending decisions in many instances until they see a more clear outlook. The trick now is to take advantage of all the policy decisions that have been made that are now available to businesses, things like access to cash flow and so on, and depreciated or accelerated depreciation. So there is a great opportunity to invest now, but the data for that second quarter will show a pretty significant fall, probably around about a 8 to 10% fall for the second quarter. Here's a quote which I think perhaps puts a slightly different spin on all of this, and it's a quote from CEO head Larry Fink, where he notes that people are fundamentally changing the way they workshop, travel and gather, and that therefore the post-pandemic economy will be a very different one. And I think that sort of goes to the point of the imperative for businesses to rapidly adapt to the post-pandemic society, because it's going to be one where, to thrive in the post-pandemic economy, your business model is going to need to have adapted to changing, not so much changing demographics, but changing societal behavioural aspects to shopping and to undertaking commerce. So maybe that means we should be less concerned about the quantitative side of all these numbers. How high is the unemployment rate going and how deep is the GDP fall going to be, and more be looking at the qualitative side of it, of which businesses can best thrive in the post-pandemic economy. So just moving on to property, and this is always a contentious one. Everyone's got a view on property, and and it was obviously one of the markets most impacted initially first impacted by COVID-19, given you could suddenly no longer have public auctions. We did see quite a lot of predictions of 10, 20%, even 30% falls in residential property, but really that hasn't come through in the numbers at all yet. And in fact, not only have we continued to see the housing market holding up pretty well, but whilst Melbourne's down 3.5% through the pandemic period, and Sydney and Perth off 2%, you look at Hobart, Adelaide and Canberra actually at record highs. And that's just the capital cities. Then you start to look at regional Australia, and something that we commented on again 4 months ago when we last had a catch up, demand for regional property has been very strong. So these numbers for the second quarter show that whilst capitals fell over 1%, regional property prices actually rose 0.3. So, our official call for property is around about a 7% fall on average for this new financial year. We think it'll be single-digit falls in most cities, and for some capitals, they'll probably still manage to actually move higher. And I think Canberra, Hobart and Adelaide are good examples of that. And for many regions, we expect to see really strong demand. And it does make sense, given what we've been through, that people might be more inclined to get away from high density population locations and go to where there's a bit more room. I suppose one of the consequences of having needed to work from home is it's forced technology upon us, and it's actually proven to be quite effective in many respects. It certainly can't go on forever, but in the short term, we've sort of proved up that the technology can support working from different locations, more remote locations, and I think we're starting to see that with the property trends. The other comment I'd make about property is that actually the owner-occupier side has been holding up relatively well, but the investor side is where you're seeing the largest stress, and that makes sense given the financial conditions we're in. Similarly, you're seeing divergence between detached dwellings and high-rise, and I think that trend is likely to be in place for next year as well. So that's the residential property markets. I haven't talked about commercial property, mainly because I just think it's so difficult to anticipate, region by region and in different parts of commercial property. But I think it's going to be a pretty difficult 12 months ahead until the economy really starts getting back to full capacity. Having said that, if you look at the financial markets, you wouldn't know that we just had a recession. If you told me at the start of the year the Aussie would be at 72 cents in August, I wouldn't have concluded we're about to have the largest global recession in 100 years. But that's been a real V shape there. And I think that really does end the downtrend that we've seen over the last decade, from the Aussie being up at as high as $1.10 in 2011, pretty much halved by getting down to 55 cents in March. And I'd expect that we're now in a new multi-year uptrend from here. A lot of that, I think, comes back to the weaker US dollar and some of the relativities I've talked about with the COVID numbers. As it happens from here, I could see a dip in the Aussie back to 68 or maybe 67, but that's nowhere near the 55 cents we got down to. So it does look like we're in for a bit of a recovery phase as some of the relativities of our economy come to the fore. Similar shape, actually, speaking of the financial markets, with the stock market. And obviously it was very different going into the COVID-19, given equity markets were at a record high. But you can see we had that similar price behaviour with the V shape and then the recovery since. Interestingly, for Australia, we've only regained just over half of our losses, whereas for the United States, they've recaptured all of their losses. And so, there's a lot of faith, not just in a vaccine and when that might become available, but also that policy support is here to stay. So just rounding out the discussion on the markets, you know, bond markets are going to be very flat. The official cash rate here will be staying at 0.25% for years to come. Good to hear the Reserve Bank not being tempted to go into negative rates. We've obviously already got negative rates for Japan and Europe, and talk about them happening in New Zealand and the US. But I think we can be pretty confident the Reserve Bank will sit tight and keep us at 0.25%. Maybe they'll take it down to 10 basis points rather than 25, but I'm pleased that they've ruled out negative interest rates, because I'm not actually convinced they work terribly well. And the other thing which the Reserve Bank has done very effectively is quantitative easing, where they've got the 3-year bond rate down to 0.25%. So I think that is a good news item, the support from the Reserve Bank to complement all the fiscal packages. Obviously not so good if you're an investor, but at least some of the other markets have been more buoyant. I mentioned the stock market picking up. And I think this is another piece of good news, is the fact that commodity markets have been bouncing back very strongly. Gold at a record price, iron ore I mentioned before. A bit of a mixed bag for some of these other markets, but you know, when we saw the oil price collapse in April, I think there were real concerns that commodity markets might be in for a tough time, but they've actually been really strong, and that's mainly on the back of all the stimulus measures. And just with you know, agriculture and some of the mixed prices for soft commodities, I think that the good news there is that we've seen the drought break in a number of regions, and I think they're officially calling a La Nina market as well. So that's good. I'll just move on to the second last slide, and the fifth piece of good news, which is the support that the government's been providing, and the fact that we could afford it as a AAA rated country. And you know, JobKeeper I've talked about. Interesting, so much of the support has also come from early access to super, over 500,000 people accessing their super, over $40 billion. A bit concerned about how that might play out in the longer term, but nevertheless, we talked about debt levels before. Even if Australia's gross debt to GDP hits 50%, which would be $1 trillion in debt, we're still nowhere near so many other countries around the world who've got debt to GDP around 100%. So, as I mentioned before, great that the Reserve Bank can and the government can access funding at cheap levels, and this is the cheapest that the government can access 10-year funding in history, or since Federation in 1901. So, fill your boots is all I can say. Righto, I won't dwell on quantitative easing other than to note that I think it's going to continue, and that seems to be fine. The only risk with some aspects of that is if you get inflation emerging, but I don't think there's any signs of that occurring at all. So just to wind up with the predictions. First of all, what's the Reserve Bank predicting? Here's a chart that I think sums it up really well, if I can just explain all these lines. So there's GDP moving up. The grey line is where GDP was forecast to continue growing ahead of the pandemic. So that was the February forecast. Then we get COVID-19. The May update was for GDP to be hit by about 10% and then take 2 years to recover. So that's the light blue line there. But then what we actually saw is that we got through May, June in better condition than feared. And so that's been upgraded to only a 7% hit to GDP. But because of the Victorian second wave, it's now going to take a bit longer than 2 years to get back to the pre-COVID levels of the economy. So good news is that we can outperform some of these forecasts, as was the case in May, June. Bad news is when you get a secondary outbreak or a new cluster, then you risk it all taking longer to recover. So there's a lot of uncertainty still ahead, but to my earlier point, we're in recovery phase now, as long as we keep the health crisis under control. So just to finish off with these predictions in written form, to summarize what I've said, Asia to outperform Europe and the Americas. Trade wars, I think, really have got a political edge to them, haven't they? They're mainly about technology wars, and I think that's what we'll be seeing in the years ahead. I've said there, Trump to lose the November election. He's a long way behind. He's climbed the hill before, but you know, I actually think it's more likely he'll defer the election than win it. But we shall see. For the record, I'm saying that he will lose to Biden. Locally, I do see the Aussie trending a bit higher, but not too far. And I do see government debt rising to above 50%. But even if we were to lose our AAA credit rating, it's the right thing to do. And I see the Reserve Bank on hold for 2 years. And I don't think they'll go to negative. State by state, as I've said before, the Victorian recovery will lag other states, very much COVID dependent, but at least the recent data has been stronger. I think the unemployment rate will actually be under 8% outside of Victoria, but probably closer to 10% for Victoria. And I talked about property before. We're only penciling in single-digit falls for property values this year, and actually gains in many of the regions. So, so they're the predictions. Once again, I'm obliged to provide my general advice warning, but perhaps I can leave you with a cautious optimist message that here's a history of all the recessions in the US, actually, and you can see the recessions are generally brief and the expansions after them are generally a lot longer. So let's hope that's exactly what we see this time. I will pause there for questions, Guy.
Yeah, let's really hope that that comes out this time with those longer recoveries and shorter recessions. Just one on there. The market, you know, that it's quite fascinating that here we are in just really dire times, and it's a crisis really, and yet we're seeing record levels in a lot of the markets around the world. Is that herd mentality? What do you think is really driving that?
I think there's a few things at play there, and it does seem counterintuitive that the US stock market could make a record high in February, then have a dive, and then make a fresh record high in August. It's just extraordinary. I think the few factors are, firstly, we mentioned the record low interest rates. And so when central banks are all around the world, including here, cut rates to zero, you know, there are still funds out there, whether or not it's super funds or investors or fund managers, they've got to park their money somewhere, and clearly putting it in returns close to zero is going to be a smaller percentage of their book. So they've got to chance their arm in the markets, including the stock market. Secondly, though, and maybe with a little more genuine support to why stock prices should be recovering, firstly, they do look at the long-term returns, not just the return for this year. And so they've got to look at, you know, 4 or 5 years of performance. And the feeling is, or the confidence is, that once we get the vaccine, fingers crossed, it actually works and can be distributed quickly, that companies go back to being profitable again, and that therefore it makes sense to have shares in them. And thirdly, you know, we are in arguably the greatest technological revolution in history. You know, the curve of technology, you know, innovation. Just look at stocks like Tesla in the US. It's just remarkable, and they don't even make any money yet, I don't think. So really, I think there's a lot of confidence that the technological revolution will continue to accelerate. And you're seeing some examples of that in Australia as well, where Australia's got its all tech index now, and that's been powering ahead. So they're probably the main reasons why stocks are sounding, you know, relatively confident despite everything that we're needing to deal with at a local level.
Yeah, right. Okay. Yeah, thanks. Yeah, I just find it yeah, fascinating with that side of things, with the bounce. One still probably keeping on the international stage. You see the debts there, that there's some really climbing debts. This is probably a bit of, you know, a simple question, but it's pertinent. You look at Japan, you know, they've been in debt for years and years and years, and now they're over 200%. When do they actually have to pay that back? Surely the coffers have got to run out.
It's a great question. Well, 2 things to say about Japan. Firstly, that yes, they're at gross debt to GDP of about 220%, but at least they owe that all or mainly locally. It's not foreign debt. So it's mainly government bodies like super funds and so on investing in it, and also individuals within Japan. The second point, though, is, and this is where I mentioned MMT, modern monetary theory, earlier, and our Reserve Bank Governor, Philip Lowe, was at pains to sort of talk it down the other day when he gave a speech saying, you know, they don't want to monetize debt and there's no free lunch and debt eventually needs to be repaid. But he's a little bit dancing around the reality that, well, actually, Japan's example would suggest that you don't have to repay the debt, you can just sit on it as long as people are prepared to continue to support it. And they've got, you know, 0 to negative interest rates there, so it's not exactly a large interest burden coming with that debt. I suppose it does have the assumption that people are going to continue to roll over their bonds with the Bank of Japan and with the Japanese government effectively. So does it need to get paid back? Yeah, well, it does, but there's no great rush, I think would be my comment, given how low interest rates are. You go back to World War II, Australia got up to debt to GDP of over 100% then. It wasn't paid off till, I think, the late 50s, it might even been later. But it eventually, you go through booms and you gradually pay it off. And again, modern monetary theory suggests there's no risks to that. You're not going to default because you're the issuer of the currency, so you can't default. The only risk is if you get hyperinflation, and that only happens in certain circumstances, and we're not in those circumstances at present. So that suggests we should be less worried about debt than you might otherwise be. Yes, you know, state governments and businesses and other enterprises need to worry about sort of creditworthiness and so on and debt ratios, but a government that issues the currency has less to worry about.
Yeah, okay, makes perfect sense. Thanks, David. Look, probably final question, just looking at time and as well, and we'll sort of start to wrap it up. You know, a lot of our partners and businesses that we lend to are the small to medium enterprises in Australia here. So no doubt that that's sort of where these questions are coming from. It's just what do you think of all of this? Because, you know, we always hear about small medium enterprises, what's drive the engine of the economy. How do you see that in this current environment? You know, what's the impact going to be? Because there's a lot of small businesses out there hurting. So what kind of long-term effects, or do you see that happening now with where we're at?
Yeah, so obviously it's been very difficult for everyone, and for businesses and small businesses are a part of that. You know, what the anecdotal evidence that we're gaining through our organisation is that, in particular outside of Victoria, that some of the activity levels have been picking up, and that as the economy reopens, that those businesses are getting back into their stride. But it's very diverse, those outcomes, geographically, a lot of divergence in those outcomes. Capital cities versus regions, Victoria versus the rest of Australia, and then just industry versus industry, and, you know, depends if your business is dependent on tourism or not. If we think about, you know, dependence on tourism, we're not going to have international tourism for probably 2 years plus, but we're going to have local tourism, and so it's a case of where that activity is going to come from. So look, you know, the government support has been welcome. I mentioned some of those packages before, and things like cash flow support and incentives for you know, investing, so you know, depreciation, accelerated depreciation and so on. We are seeing evidence of businesses starting to get interested again in you know, taking advantage of the not just the fiscal packages but the low rates and so on. But equally, it's cautious because, you know, people have been paying down debt for a period, and now it's a case of when that will turn the corner. And so I very much matched to when the economy gets back into its stride. And as you know, we've talked about a U and a V-shaped recovery. There's also talk of a K-shaped recovery, where some parts will be recovering quite nicely and others just won't be able to get back onto their feet because of how it's impacted different sectors to different degrees. You know, my last comment around all of this is it's a great time to invest and to get on the right side of, investing in technology and innovation, given where rates are and so on, and given the economic cycle. But you've got to just pick your moment and then back yourself that you've got the business plan that can actually feed into that, where that post-pandemic demand is going to come from. But being on the right side of technology and innovation is absolutely crucial, and that's going to depend a lot, vary a lot depending on which particular sector you're in.
Yeah, that's interesting. The K-shaped recovery. Yeah, that'll be. Look, I can definitely see that, and we're seeing that with clients and the inquiries that we get coming in from the business as well. So that's probably pretty pertinent. Okay, look, in the interest of times, I just want to first of all thank David very much for his time. It's a great partnership that we've got, and we're really impressed, and the turnout's been great again today. So thanks to everybody attending. I know there is a little bit of wariness around webinars at the moment, but I think this one's hugely important and just a really timely update for everyone, including us, when we're there. So thanks, David, and thanks to everyone who's attending. We will send out a copy of this of the webinar and to attendees. So you will receive an email with that on there. And of course, if you've got any questions, Banjo contacts, your Banjo contacts, because they will have been sent out, or please send them through to our customer service. And look, all the best in the recovering economy. We hope that the W shape is the end of it, and Victoria's numbers keep coming down, and borders start opening, and everything starts sort of flowing again, apart from that international travel. But yeah, thank you once again, David, and I'm sure on behalf of everybody here, it's been a great session.
It's a pleasure. Thanks for having me.
All right. Take care. Have a good day, everybody. Thank you.